So I wanted to talk a little bit about the challenges and opportunities I see for marketplace lending over the short term and also the next 5 to 10 years. Before I do that, I just thought I'd talk a little bit about Funding Circle and who we are for those that don't know who we are. So Funding Circle is the global leader in marketplace lending to small businesses. We've originated over $2 billion of loans to small businesses since we launched in the UK. We're the only player really trying to operate across multiple geographies. So we launched in the UK in 2010, in the US in 2013, and recently in Germany, Spain, and the Netherlands. So really trying to take a global approach to the business and completely focused on small business borrowers. Last year, we did over $1 billion, so $1.1 billion of origination, and we expect to continue to grow very fast in the future, growing fast in the industry, it seems. So last year was a very exciting year for us. We had a number of great milestones. We raised $150 million from a set of very blue chip investors. So DST, BlackRock, Ballygifford, Temasek, which is the Singaporean Sovereign Wealth Fund, and also a mutual fund in the US called Sands Capital. In October, we launched in continental Europe, so we put our business together with Zencap, which now trades as Funding Circle Continental Europe. That's been a great transaction so far. And in November, we raised £150 million for the first listed vehicle in the space that's tied to a platform. So there have been previously successful launches of listed investment trusts in the UK. P2PGI, Victory Park have done a great job. This was the first time that a marketplace has raised a fund dedicated to one platform only. And what that means is you can now go and buy a share in this company. It's trading on the London Stock Exchange right now, and get access to all our global loans, diversification, in a very, very cost-effective way. So no performance fees, no management fees. And interestingly, in the context of some of the stuff David was talking about, we were very pleased in February to welcome Jorg Asmussen to our board. Jorg has had a very distinguished career. He was on the ECB board, which, for those of you who don't know, is the largest central bank in the world. But he was also previously the chairman of the German regulator BaFin, so in many ways a German Lord Turner. So enough about funny stuff. So we're in very uncertain economic times, so we've had a great period as an industry, but we know there are a lot of headwinds going on at the moment. In the UK, there's particular talk about Brexit. In the US, the election. Equity markets have been very, very volatile at the beginning of the year. We're starting to see some upticks in delinquencies in certain asset classes in the US, subprime auto, for example, and securitization markets have been pretty challenged. So there's a lot of uncertainty and probably difficult times ahead. And we also face a period of much greater scrutiny as an industry. We've seen Ponzi schemes in China that really beguile belief, to be honest. $7.6 billion apparently in a platform called Azubo. We've had a peer-to-peer lender fail in Europe, TrustBuddy, and it looks like for the first time investors will lose money due to the lack of regulation that was in place, lose client money. Lord Turner, so we'll speak a lot about him, I'm sure, today. I wouldn't necessarily, be in favor of the choice of words that he used, but I think the concerns that he raises about our industry in terms of how will we perform in a downturn, how are we doing credit assessment, are valid concerns that we should address head on. And we've also, as we now start to go into ISAs, and become regulated in the UK, there's a lot more scrutiny going on. And the final point is that listed peers of ours in the US, so the lending clubs, the Ondex, Urendi, which is a Chinese platform, have not necessarily bounced back in the same way as all technology stocks have in the last few months, last few weeks, sorry. So definitely challenging times for the industry. But as David said, we should welcome this level of scrutiny. Peer-to-peer or marketplace lending is no longer alternative finance, and I don't know if there's a rebranding that needs to happen, but we are definitely entering the mainstream. We talked about, we're going to be in ISA accounts, we're going to be regulated, there are listed vehicles now trading on the London Stock Exchange. We should welcome the level of scrutiny that is coming to this industry. And the way I think about it is we had, certainly from a funding circle perspective, a 5-year period where we were fighting every day to get investors and borrowers to come to our platform, fighting the criticism that was being levied, skepticism, things like that. We had a year of hype when it looked like we were turning water into wine. And now we're pretty much back to where we are, and we've got to really build these businesses. And certainly at Funding Circle, we welcome that. So I think some of the things that are going to be important over this period are similar to what really makes our business model special. So transparency, we've talked a lot about transparency in the past. At Funding Circle, you can get full details of our financials. We publish much more detailed reports than are required by Companies House, and we've always done. We publish loan-by-loan detail on all our loans, so you can see in real time how, or on a daily basis, how these loans are performing. And we publish detailed data on investor net returns and default rates, which the Peer-to-Peer Finance Association has really been at the forefront of pushing. Now, the thing with transparency is no one ever thanks you for being more transparent. In fact, it's actually quite the opposite. So as we push towards transparency, we're way more transparent than banks and other financial institutions. I mean, who knows what's going on in the $2.6 trillion of assets that JP Morgan has on their balance sheet, whereas, you can get a pretty good idea of how marketplace lending platforms are performing. So by not taking balance sheet risk and being pure marketplaces, this is what we think is transparency is really our skin in the game. We have no money to lend ourselves. If we don't deliver the returns and the performance that we tell investors that we're going to do, or at the very least perform better than other comparable asset classes, then we have no right to exist, and we won't exist. So by committing to transparency, we can keep building these businesses for the long term. What's also going to be important during this period is having very strong credit teams. So I think one of the things Lord Turner didn't quite appreciate about our industry is he maybe thought that we're just a bunch of kids running around, technology guys trying to build these businesses without a real appreciation of credit. Now, that may well have been true 5 years ago, but it certainly isn't true today. So at Funding Circle, our global chief risk officer is a gentleman called Jerome Leloul. He was chief risk officer of Barclaycard globally, so managed their £40 billion portfolio. On top of that, we have local chief risk officers for our regions with significant expertise of local credit system, in particular in the SME space. We have global controls over quality, policy, procedures, making sure regions are in line with guidelines. And another big difference is, again, every loan that goes through Funding Circle gets looked at by a team of manual credit assessors as well. And I know it's pretty similar at most of the platforms here. We have a team of 37 dedicated SME loan underwriters globally, 313 years of experience. So again, the idea that these are just fully automated platforms, that loans are just going through without anyone having a look at them, is completely false and doesn't actually match the reality. On top of that, we are also investing a lot in data and risk analytics. Over this period, as I said before, Funding Circle has done $2 billion of loans over 5.5 years. There's some very rich data and analytics that we're now able to do around risk, around what time of day you apply to the platform, what channel you come to us from. The amount of richness that we are able to do now is pretty extraordinary. And if you think about it, marketplaces are the only platforms really, other than banks, that are doing long-term loans and have this large amount of data. So, I think having really strong credit expertise is going to be really important. It's not enough to just be technology businesses. We need to have this expertise. It's the fintech, the fin in the tech bit. And by having these strong credit assessment teams, what we really need to do is continue to deliver consistent, predictable credit performance over time. What you see with Funding Circle is that we have continually got better and better delivering against expectations and exceeding those expectations. And what we also regularly do is stress test these loan portfolios. So again, the question that often comes up is, how will these loans perform in a recession? The honest answer is we don't know. But if you actually look at, we've tried to take a pretty sensible way of guessing or analyzing what that would be. The first thing is that you've had a number of institutions with a lot of data, people like Moody's, looking at loan portfolios originated by marketplace lenders and comparing them to banks. There are papers that you can download from Moody's on that today. And the first thing that they found is that the loans that are originated by marketplace lending platforms aren't actually that different to the loans going through banks. They don't skew in any way, they don't look more risky. They're pretty much what you would see in a bank loan securitization. The second bit is that we regularly stress test these loan portfolios with external consultants. So at Funding Circle, we've gone through PRA tests, stress tests, we've subjected ourselves to those, and we've published the results online. And what they have found is that in a downturn or a recessionary environment like 2008, loan losses would increase by around 60%. Now, conservatively, within Funding Circle, we actually model to loan losses doubling. But if you look at the interest rate coverage on these loans, it's very, very high. At Funding Circle in the UK, we charge around 10% on average to borrowers, and our annual losses are around 2%. So there's 5x coverage of losses built into the interest rate. Put another way, losses would have to go up 5 times for principal to be at risk. So, these loans, I think, will be very, very resilient in a downturn, and whilst they will yield lower returns than they have done in good times, they'll certainly be better than any other asset classes out there when the stock markets are crashing 30%. Typically, high yield indexes are going down quite a lot as well. Another thing that's going to be really important during this period, if we commit to this, if you commit to the pure marketplace model, not taking risk, balance sheet risk, is having a very diversified base of capital. So retail investors are really important. Funding Circle has the largest base of retail investors targeted at small business lending. And certainly over the last 5 years in the UK, no one has added more retail investors than us to a platform. So that is going to be a really important part of the mix going forward. What's unique about small business lending is we also have a number of government institutions lending through us. We have 17 county councils. We have the British Business Bank, which I know is lending through a number of different platforms. So government is also stepping in here to help get the flow of credit moving to small businesses. There are institutional investors as well, ranging from hedge funds to insurance companies to pension funds. And we've talked before about the Funding Circle SME Income Fund. So the important thing here is to continue to diversify. There are going to be more and more sources of capital coming into the industry, things that we haven't even thought of yet. You see banks already starting to participate as well. But making sure we have real depth and breadth on the lender side is going to be a key to these platforms surviving and thriving. And the final bit that we have to be really conscious of is just making sure that we are not posing a systemic risk in the system. So maturity transformation, true marketplaces, I feel, don't do maturity transformation. Taking short-term money and lending it long-term, that's a recipe for disaster, and it has been in the past in many ways. So by not doing maturity transformation, by perfectly matching assets, there's no risk of a bank run, there's no risk of substantial loss to consumers because of liquidity issues. We don't take deposits, and what I mean by that is we don't promise people a guaranteed return. This is capital at risk. Your returns can go up, they can go down. It's very important that by doing that, we don't promise, but we can provide higher returns to investors. But it's very important that we don't promise or give the illusion that we're guaranteeing returns. And the final bit is not holding inventory. I've talked many times in the past about how I feel you can only truly be aligned with investors if you don't hold inventory and if you don't take balance sheet risk. I think that there's one exception, which may be if you're launching a new product or in the early days you don't necessarily want to expose investors to a new asset class. But beyond that, I feel that it's very important that by not holding inventory, you're more aligned with investors because you're not incentivized to do weird things. And by weird, I mean, in the crisis, we saw many, many times where when your back's up against the wall and you have a balance sheet and you sell loans, the incentive is always to keep the best loans for yourself and sell the worst ones to investors. And that is a very powerful incentive when things go wrong. And we saw many times in the crisis that the securitizations, the covered bonds, the loan sales happening around the time of the crisis performed significantly worse than the ones that were done right before. Banks, other institutions were stuffing bad loans into these cohorts. By not doing that, by only facilitating the lending of capital, we have to make sure we perform, otherwise we don't exist. So, I think those are the things that we need to do. There's been a lot of negativity on the industry recently. I talked a lot about the different things that people are saying earlier. And sure, we have these short-term challenges. It's going to be hard work. The kind of hype phase or the hype year is definitely over. But my view is that when you take a step back, the medium-term to long-term prospects for our industry are better than ever. So when we started Funding Circle in the UK, we quit our jobs around 2009. We felt that there was a compelling customer opportunity, but we also felt there were a number of macro factors that made this business model really attractive. So the first was that we felt that interest rates would stay low for a very long time, that we were in a Japan-style, lost decade, lost 20 years now. And that even when interest rates rose, they wouldn't rise to very high levels. And whilst our business model works regardless of the economic climate and regardless of where interest rates are, it's a hell of a lot easier building it when interest rates are pretty much zero. And I think that trend is going to perpetuate over the next period. I think if anything, the dovish statements from the Fed, interest rates are likely to stay lower for longer. The other big macro trend we saw was that people were losing trust and satisfaction with banks. They had gone through the crisis, that had created a lot of mistrust, bailouts, things like that. And on the small business side, we see that even more, in an even more extreme way, especially in the UK with interest rate swap mis-selling. Banks have really lost trust and satisfaction. Businesses have really lost trust and satisfaction with banks. And the final bit that we thought was that banks would become very regulated, they would have very high capital requirements, and they would look much more like utilities in the future. And that's right, because if we're all on the hook to bail out RBS or another bank, we should make sure that they are very low risk, that they have very high capital buffers. We don't really care if they make a high return on equity, we just want to make sure that they don't bring down the financial system in the future. All of those three things are as prevalent, if not more prevalent today than they were even when we started the business. So, and even in December, before a lot of the ructions that happened in the markets are. So, to the critics, I would say, I actually think the opposite is true now. I don't think this is, the end of marketplace lending or the beginning of the end. I actually think this is the beginning of the golden age for our industry. We have already originated a lot of credit. We've proven that we can originate credit in a good fashion. We've proven that these loans don't look that different. We're not taking all the loans that banks don't want to do. We're actually taking share. We might be doing a few of those loans, but we're taking a lot of share as well. So this is really going to be the golden age for our industry. Now, that doesn't mean it's not going to be tough and it's going to be hard. As I said, we've spent many years with our backs against the wall building these businesses and building this industry. And not all of us are going to make it through this period. Marketplace lending is a scale business. You need to be doing hundreds of millions and then billions of dollars of loans to be able to get the data to make this work. But I think the businesses that emerge through this period are going to be much stronger and much more resilient, and as I said, usher in this golden age. And I think the reason why we've just got to take a step back from all this stuff and all this criticism is to really look at why do we exist? We have no right to exist if we're pure marketplaces. We don't lend any money. We don't actually have any money on our balance sheets to lend. So the only reason we exist is because we provide a huge amount of value to customers on both sides of the equation, to borrowers and investors. So for small businesses in the UK, you can see from these net promoter scores at Funding Circle, they're on another level to banks. I mean, negative in the UK even. The highest bank we've seen is Virgin at around 20% NPS score. So this is a measure of how your customers feel about you. US, doing a little bit better. So there's a huge amount of value being added on the small business side in terms of speed, in terms of convenience, in terms of price. 77% of small businesses that borrow through Funding Circle tell us they would always come back to us first for a loan in the future. So, we must be doing something right. We must be doing something different for all these customers to be coming to us. And on the other side of the equation, we are providing attractive, stable, risk-adjusted returns to investors. So if you look at Funding Circle loans over the past 5 years, they have actually, on a cumulative basis, achieved a better return than the FTSE 100 or corporate bonds. And obviously past performance is not a guide to future performance, but we've got a pretty good track record so far with a lot less volatility than other asset classes. So we're adding a huge amount of value, and that's why customers are choosing to come to us, and that's why these platforms are growing fast. It's because we provide a true large amount of customer benefit. I've talked to Jamie Dimon a little bit about this because JP Morgan have started saying this, and I'm assuming it wasn't because of us, it was because of someone else. But what I think marketplaces do really well on the borrower side is they're faster, better, and they're cheaper. And there are extremely powerful network effects to these businesses. These are very much like exchanges. So the more loans that we do, the more data we're able to gather on these businesses or consumers. That means that we can achieve better underwriting models, better processes. That means we can increase our acceptance rates to borrowers as we're able to predict their risk, which means we can spend more money on marketing and our acquisition costs come down, which means we can do more loans. So you can see this very virtuous circle that is extremely powerful and something that banks just cannot replicate because of regulatory capital requirements and things like that. So these models, can genuinely be superior to what exists in the banking system. At the beginning of the year, I told a lot of Funding Circle employees, I sent a letter to everyone saying, it's going to be a tougher year this year. I didn't expect it to get this tough this quickly, but it is definitely going to be a tougher period. And one of the things I've always set as a long-term goal for our company is to be doing around $100 billion of origination a year by 2025. So about 100 times, a bit less than 100 times as big as we are today. And I think that goal is more likely, the probability of reaching that outcome is more likely today than I did 3 or 4 months ago. For all the reasons I outlined before. We are fundamentally lower cost than the banking system. Now, I think what we've done is we've done a good job of explaining how we've driven down operational costs through technology. Renaud from Lending Club often talks about how banks operate at much higher costs, and that kind of makes some sense. We probably have a 3 to 4x advantage over banks in that respect. But what I don't think we've done as good a job about, and I think for analysts in the room, I think this is a kind of throwing down the gauntlet to you for a bit, is explaining how much more capital efficient our model is than the banking system. If you commit to the true marketplace model, the amount of capital that you need to originate around $100 billion a year of lending is practically minuscule. And when you combine those two things together, the return on equity for platforms like Funding Circle and others is not in the order of magnitude of 3 to 4 times better than banks. It's in the order of magnitude of hundreds of times better. These are much better, much more efficient capital allocators and intermediaries than the banking system. And hopefully, someone will figure out what the return on equity is in the future, and they can start talking about that. We deliver a fundamentally better customer experience. We've seen that on these other slides. This is just a better business model. We're global, so we're starting to see in comparable exchanges like the London Stock Exchange and Deutsche Börse and now IC, potentially getting involved, that exchanges are much larger exchanges than us are understanding that capital is starting to become global, that being global is in the exchange space is a much better business model. And you're starting to see that, I think, in marketplace lending, and I'm sure others will follow. And being a partner and just part of the infrastructure, as I said, we are like exchanges. We're like the London Stock Exchange for business loans. That means that we want anyone to be able to come and participate. Funding Circle took the lead in this with partnerships with Santander and RBS. We've seen similar partnerships in the US with OnDeck and JP Morgan, and others I'm sure to come in the future. So I think if you view these things like exchanges, then the participants will be wide-ranging. And the final thing I wanted to leave you with is, if you think about, we talk a lot about money and 100 billion a year, makes you feel a bit gaudy sometimes talking about just billions all the time. But I don't think we should forget that at the heart of this, we are creating huge numbers of jobs, huge numbers of opportunity in certainly the small business space in the world. 100 billion a year equates to 3 million new jobs being created every single year, which is an extraordinary number. And we've often thought about what is small business? What does it really mean? A lot of people love small businesses, but why do they love small business? And the reason is because what small business represents is opportunity, creativity, taking on the bigger guy, and that's something that everyone can get behind. And that's really what platforms like Funding Circle are as well. And that's why we will always provide a much superior service to the institutions we compete with, because we understand small businesses in a way that banks never will. So that's it. Thanks for listening.